We just wrapped up a great conversation with Tim Lyons. Tim came prepared to talk about everything that he's got going on, raising money, syndications, doing his first deal, which he jumped right into a small multifamily. He did not take the step of doing single family. He got right into it. And we shared a lot of great conversation about how to raise money properly and all those kind of things that are involved with syndicating deals. Patrick, what do you think about the episode? Anything that was a key highlight that you want to share?
Great key highlights. I mean, from reading Rich Dad Poor Dad to buying his first property in 4 months, doubling his money in 2 years on his investment and hitting those goals of raising $10 million a year. I think you guys are going to absolutely love this episode. We get into some key things for the next 6 to 12 months with all the data he's got. So listen to the end. You guys are going to love it.
Yeah, stay until the end. Any of our macro listeners who like that macro kind of stuff, we got some great insight there too. So it's a great episode. Stay tuned.
How's it going, everybody? And welcome back to the Real FI Podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it going today, James?
Going well, Patrick. Switched it up today. I'm in the office, not at home from my home office. So hopefully the sound's coming through okay. I don't have all the equipment that I do at other locations. So that being said, I think we're going to have a great episode today. We have Tim Lyons on with us. Tim is going to give us a wealth of knowledge and background and let us know all the things that he's got going on. So we're really excited to speak with Tim. So why don't we go ahead and get it started, Tim? Why don't you introduce yourself to our guests and tell us a little bit about what you've got going on?
Guys, I just want to take a minute here and say thank you so much for launching this podcast, for having me as a guest. And I think you guys are doing awesome. So the more information we can get out to people, the better it is. So thank you. So my name is Tim Lyons. I'm the managing partner of a company called Cityside Capital that really consists of me and my brother, Greg. And we both work from home virtually. He's in Charlottesville, Virginia. I'm in New York. And I work as a New York City firefighter. I'm a lieutenant in a company in Queens. I've been doing that for 18 years, and it was a childhood dream to be a firefighter, I guess. But you know what? Taking it back, I mean, I grew up in a divorced household from a very young age. Money was an issue always. I grew up with the scarcity mindset. Debt was a four-letter word, and I used to get in trouble by my mom for saying four-letter words. Really subscribe to going to school, getting a good job, socking money away, ladder those CDs, live below your means. I mean, typical millionaire next door type of, accumulation model of building wealth. And that's what I started to do, right? 9/11 happened when I was a sophomore at Providence College, and being from the New York City area, I just knew that I knew a lot of people, which I ended up knowing a lot of people that were affected. I was pre-med at the time, and decided that day that I was going to be a New York City firefighter come hell or high water. And that's what I did. I graduated from college May 15th, and May 31st, I'm being sworn in as a New York City firefighter. Got to the firehouse, guys, and realized that most of the other firefighters had a second career. Not even just a second job, a second career. There were attorneys, financial advisors, nurses, PAs, contractors, HVAC, carpet guys. I mean, you name it. I had a guy that owned a couple bagel stores, a couple tanning salons. I mean, I felt like the odd man out because I'm like just fresh out of college, probationary firefighter. And what I found was that a couple of the guys were nurses, and they worked either in home care or in the ER or just in the hospital in general, and they had the nice cars, and their wives didn't have to work, and they had smiles on their faces, and they always had to decide to work when they wanted it. And I was like, you know what? I was pre-med for about 15 minutes in college. Like, I think I can handle some nursing school, So I went back to school, right? Because that's what we think. We think we need to go back and get degrees to enhance our financial position, which, this one did for a while. And I before I had kids, it worked out great. A couple of vacations a year, maxed out to 457. The bills were paid, money was in the account, and everybody's happy. Well, guys, I ended up having 3 little girls who are now 12, 9, and almost 4. A couple of weeks, she'll be 4. And when they were little, they didn't ask a lot of questions. When I was in the firehouse, 24-hour shifts, come home, witching hour at night, get a book in bed, and I'd be gone by 6:15 the next morning to go do a 12 and a half hour shift in the ER. and they started to feel it. I started to feel it. My wife started to feel it. I didn't know it at the time. It's called trading your time for money. And I, for some reason, I had this mental block against podcasts. I thought that only losers listen to podcasts. I don't know where that came from, but I wasn't on the podcast bandwagon. Well, that all changed. Summer of 2019, I read Rich Dad Poor Dad on a family vacation with my brothers, my dad, the kids. Everybody's going crazy, and I can't put this book down. I'm literally building a sandcastle with one hand, and I got the book in the other. I got the kids hanging all over me, and yeah, within a day or so, I decided that I was going to get into real estate. So I'll hit pause there and see if you want to unpack any of that.
Yeah, I mean that's incredible. That's a very interesting story, and I know that a lot of people come to that realization, like you said, once they realize they're trading time for money, and that's the key to having that realization hit and then changing one's life. I think a lot of people go through that process. I'm curious. So what was it about being a firefighter that allowed a lot of people to have that second career going at the same time? Because I'm sure a lot of people are thinking, like, how do you even balance that? Was it because of the shifts you work, the hours? Like, what did that look like?
Yeah, so generally speaking, I mean, so I can only speak for New York City, but for New York City, we have a chart, right? And it's like it runs our life. Everybody has a group number. There's numbers from 1 to 25, and everybody has a number, and it's plotted out on these calendars, and then you could literally see when you're going to work for the whole year. But what guys do is that we make 24-hour shifts. So we have a 24 partner. We'll make these 24. I do the first half, you do the second half, right? So we'll work 24 hours, and then we'll have like anywhere from 2 to 4 days off, depending on how the chart kind of falls into line. An easier way to think about it, other cities will do the A, B, C, D chart. So if I'm in group A, every time A, I'll work A, I'll be off for B, C, and D, and then I work A again, B, C, D off, So having all that time off allows guys to really start second, third careers, own businesses, do incredible stuff because they have the time off. And especially when I first got on 18 years ago, there wasn't a whole lot of overtime. Like the overtime was very, very scarce. Like people used to like claw at each other for the overtime. And now it's different, right? We've had some things happen in New York City where we haven't been hiring as fast or as much, and there's been moratoriums on hiring at different times. So we're kind of understaffed a little bit. So there's a ton of overtime. But that wasn't always like that. So that's why guys kind of by necessity, I think there's a certain breed of people that want to be firefighters. They don't usually sit still all that well. So when they're home for 3 days at a time, instead of just, going to the beach or something, they just decided to work.
Yeah, that makes a ton of sense. I know a lot of guys in the union, in some of the unions do that as well. My brother works at the Port of Baltimore as a longshoreman. And, a lot of the guys, they put in, their 5 or 10 years, get their seniority up, and, they decide to work their 30 or 40 hours, maybe like Thursday to Sunday. And then the rest of the week, they've got their businesses. They're doing kind of the same thing. So it's in a lot of the trades, you're able to kind of do that. And, other people working their standard 9 to 5 don't necessarily have that opportunity except after hours. So it puts you in the perfect position to be able to do another career or something else. And I really kind of want to unpack, what led you to real estate. We know Rich Dad Poor Dad, but like, what was it about that like, it sounds like instantly made a connection with you? I know like your daughters were getting older, so I'm sure it was something to do with that, but break that down for us a little bit.
So I only had like excuse me, a little bit like a minimal capital stack to start with. And I'm like, well, how do I grow this? Right. Because 3 to 5% a year in like some sort of like safe, illiquid, instrument, this wasn't going to do it. Right. I needed equity. And I realized that when he kept on harping, Robert kept on harping about the rich don't work for money, they have money work for them. Right. And I kept on like really hit a nerve. I'm like, man, I'm working 80, 90 hours a week. Right. And yes, I'm contributing to the hospital retirement plan, the firehouse retirement plan. I got a pension to look forward to. And, part of me was like, well, just count your blessings. Not everybody has a pension these days. And, 9 out of 10 people will never even know what a pension is, and it just wasn't good enough for me, right? Like I wanted to be home. I'm not allergic to working. You know, I want to work hard. I want to do something, you know, every day, but I didn't want to trade my time for money. So that really was like the allure, right? How to make my money work for me. And he talks a lot about using other people's money, and that was a really like a weird concept to me. Like, man, how do you use other people's money? Like that just doesn't make a lot of sense. I'm from New York, right? Everybody's guilty till proven innocent in my mind. You know, I mean, I don't trust anybody. I want to like, you know, touch and feel the property, and I want to mow the lawn, and I don't want anybody looking at me or my property. You know, like, it's just weird. I don't know. I was a weirdo back then. So, you know, that really started it. And then, you know, that book led to the cash flow quadrant, right? Which is like, you know, Rich Dad Poor Dad is like the overall the overarching theme of what to do, right? And the cash flow quadrant is more of like the tactics. And that led me to Tax Free Wealth by Tom Wheelwright, which led me to, you know, Real Estate Secrets or something else by Garrett Sutton, I think it is, and Run Your Own LLC. And all of a sudden, I'm like, man, business and real estate, the two things that have equity that keep on popping up on top of the radar, was business and real estate. So real estate made sense to me. I had already bought and sold two houses, right? Primary residences. And I'm like, yeah, you know, I can figure that out. I mean, I gotta have your cash flow be more than your expenses. Like, cool, I got it. But I was scared, right? I was super scared. I was nervous. I didn't, you know, selling it to the wife. I'm like, babe, you know, I'm going to take our life savings and I'm going to buy a 3-family property with our buddy Craig. Like, we're going to make it happen. And she's like, well, Tim, you know, I don't even let you hang pictures on the wall because you're allergic to a hammer. So how are you, like, how do you think you're going to like take that fixer upper, you know? And, anyway, long story short, I bought this 3-family property 2 months after reading Rich Dad Poor Dad, and with a friend of mine, and it was a 3-family because I was scared of a single-family rental. Right, if somebody leaves, I have 100% vacancy. Like, oh my god, what am I going to do? And you know, we fixed up the first 4 unit. We YouTubed our way through putting down LVP flooring, and I painted myself, so I probably missed a couple of corners, but that's okay. And we started cash flowing, you know, between $400 and $700 each a month. And then we did better on our taxes that first year. And now my wife's like, dude, like, okay, like I see where this is going, right? This looks good. You know, so I had buy-in. And I also had buy-in from myself, right? Because I wanted to be the landlord. I wanted to understand what it meant to be a landlord. Is there a proverbial 2 a.m. phone call? I never got one. But that's how I got my start. And, you know, realizing that I didn't have to put my well, this is almost like an oxymoron. My wife said to me, you know, Tim, you're a firefighter, a nurse, and now you're going to the property like twice a week. And it's like a half hour there, half hour back. You're there for 2 hours. Like, it's kind of like another job. Like, where's this passivity coming in with the passive income, you know? And I was like, babe, you know, just trust the process. But really, I mean, I'll stop there, but I started off with the 3-family property.
Well, I
I
think that's a
I
misconception that a lot of people have is like the passive income of it. I mean, you said it right when you first started talking about it. It's the business and real estate. It's the business of real estate that people need to get into, and that takes time. It just doesn't happen overnight unless you've got a couple $1 million sitting in the bank that you can put into some syndications or something. Other than that, it's not really passive. And still, at that time, you know, you're managing the managers and the property managers too. But I'm curious to dig in a little bit more into this deal, this first deal. You're in New York. Where was this property located at, and what did you buy it for?
So this property was located in New Haven, Connecticut. So, you know, New York is very hard to cash flow in. And, you know, specifically where I was living, high prices for a single family property. I'm talking four to 500,000 for a starter home, you know, that needed TLC and 10,000 a year in taxes. Like, so to cash flow that puppy using maybe even the 1% rule, like, not happening, you know. Duplexes are hard to find. And then I just didn't have the money for like a big multi, right? So you had to go out of like I personally had to go out of my little comfort zone and go across the state line to a different state, to a different, you know, city. And I bought this 3-family for $276,000, and the taxes were $6,100 a year. So we bought it with an LLC because because I saw in Bigger Pockets that, protect yourself, buy with an LLC, right? So I did that, realized that the financing was at least a point and a half higher. And I was like, oh man, like, I don't know why I did that, but it was a learning experience. And we, at the time, I think our debt was like, I should probably know this off the top of my head. I think it was 4.5%. It was a 10-year note, 4.5%, 20-year amortization. And yeah, I mean, we cash flowed very, very nicely without even raising the rent, right? The second year, we had one move out. We had a nice bump in the rent, and we increased the rent on everybody else by $25 a month. Not bad, right? I mean, it was pretty good. We then decided to refinance now this is like, November of November of 19. So by like November of 20, we have COVID, right? COVID's here, everyone's scared to death, but the prices of houses are skyrocketing.
Yep.
So I called the banker. I'm like, I just bought this thing. I don't know that we need to refinance, but the rates are still super low. I mean, we had the Fed had the interest rates at 0, right? And we refinanced, and we just took a little tiny bit of money out. Nothing crazy. And we got a 30-year mortgage fixed rate at like 4.375. And now the cash flow was really nice. I mean, we just bumped out the amortization from 20 years to 30 years. I mean, now we're sitting pretty. And then we had an offer that we couldn't refuse, an unsolicited offer. And about 2 years into the project, I said, Craig, I mean, what do you think? We're going to double our money in 2 years, And by that time, I had started my own business, Cityside Capital, and we exited, and we more than doubled our money in 2 years.
That's amazing, and I really love unpacking this story a little bit, because you've got the whole thing, right? You read the books, you're like, I'm going to take action. You took action. You decided, you realized that you couldn't find anything that met your criteria where you live, so you went outside your comfort zone. Now you're an out of state, semi-long distance investor, and you don't have the buy-in yet. And I really love hearing these types of stories, because a lot of our listeners out there, haven't bought their first property yet, or are looking to buy their first property. And these are the stories that I think get people that comfortability, because, it's not until you get that first rent check that you're like, oh, this works. This is working. You put in a little sweat equity, and that's what brings the passivity to it. And as a first-time investor, going out there in less than 2 years, doubling your money, realizing that the process works, I think that is so huge, and you went out and bought a multifamily on your first one. So I really want to break down that a little bit, because I myself went out there and bought a single family because that's what I knew. That's what I had bought. And I was like, well, let's just try this first. Let me dip my toes in. But you kind of went that next step, which I kind of wish I would have did first, and bought that small multifamily first. So what was all the thought process behind all that?
Yeah, so I think I was scared, right? I was nervous. It was my first one, and I just was really scared by the fact that if I had a single family rental, and one person either stopped paying, right, because COVID was basically coming on our shores, if they moved out and I couldn't find somebody else, or if they wrecked the place and I didn't have enough reserves, like I had a lot of limiting beliefs about the single family, but I understood it because I already bought and sold my own home, and qualified for financing and understood that process. And as your listeners may or may not know, right, you can qualify for conventional financing, 30-year fixed rate mortgages on the 1 to 4 unit, investment properties. It's only when you hit 5 or more units that it's now considered commercial, or if you purchase a 1 to 4 unit with an LLC, that you have to use commercial financing, which is more expensive, and the underwriting process is a little bit different. So I understood it. To put it very simply. And I just felt like if we could find something that maybe 2 out of 3 units paid for the expenses of the property, and the third unit maybe was just a profit, that made me feel really comfortable, right? Because look, even if 2 out of 3 left at the same exact time, we could maybe fill one and renovate one. And, it just gave us a little bit of flexibility.
Hmm.
And they didn't exist where I lived, right? So I just started looking, 20 miles away, 30 miles away, 40 miles away, and all of a sudden, a friend of mine from college and we said, you know what, let's just do it. Let's just go see what it's like. What's the worst that can happen, right? So we buy this 1929 built piece of property, and it needed siding. It was wood, that wood clapboard, it was falling off of it. It needed a new roof. And once you open up the roof, let me tell you, there was a lot of other stuff that needed to be done. So like, it was a learning experience, right? And I'm like, God, like, you go into this thing, you think you're well capitalized, and all of a sudden you start, opening walls and open up roofs. And they're like, one of my favorite was that they opened up the roof, and while they're up there, they look down the chimney, and I don't know why my inspector didn't catch this, but they had cemented the chimney shut, right? So I'm like, God, help me. I'm like, how nobody died of carbon monoxide poisoning on the third floor yet, and I just owned it for a couple of weeks. It was amazing, but I'm like, all right, let's tear down that chimney. Let's, repoint the top of the chimney. Let's maybe unclog it. But just, it's fun things like that came up. But I wanted that. I wanted that experience. I wanted that, in the trench experience of what it's like to get that phone call saying, "Hey, remember we gave you a quote of X? Well, now it's going to be Y, and here's why." So anyway, it made sense to me. I felt good about it. But as I did it, I had now unlocked my limiting belief about not listening to podcasts, and I went on a podcast tear. I mean, 2x speed. At all, at any time I was in the car, I used to listen to country music on Pandora, to work, from work, to the grocery store, back, right? I mean, like, I didn't listen to anything else. Well, guess what? Now it was straight podcast. And, all of a sudden, like, I couldn't listen to enough of them because there was so many more that I wanted to get to. So my wife's like, "Oh, we need eggs or milk." And I'm like, "Dude, I'll go. I got 7 minutes there, 7 minutes back, 7 minutes walking around the aisles. I can get a whole episode in. And I kept on hearing about regular guys, girls, I mean, stay-at-home moms, firefighters, police officers, teachers, construction folks. I mean, regular dudes, regular people were buying multis. And I'm like, how are they doing that? Right? Like, they can't be any smarter or any better than me, right? Like, if they're a firefighter in Indiana and I'm a firefighter in New York, like, I'm sure that we're probably in the same boat, like, or a similar situation. Like, I got to make this happen. So that's what I did. I just really dove into the education. I found myself a mentor in multifamily. I learned everything I could. And, the next chapter of this, guys, is that, as a New York City firefighter, I work in a neighborhood called Corona, Queens. It's aptly named Corona, Queens. And it was it was like kind of labeled the epicenter of coronavirus in New York City. I mean, people were dropping dead on the street. We didn't know a whole lot. We did CPR nonstop, 24 hours a day. It was amazing because I work in a pretty busy place, and there was no fires, there was no car accidents, there was no odors of gas, there was no cooking accidents. It was just CPR like all day for about 5-6 weeks. And at the time, I had a brand new baby at home, and we didn't know a whole lot. So I moved out of my house for 9 weeks, and I moved to my mother-in-law's house. She moved into my house to help with the kids. And for 9 weeks, I didn't see my kids or my wife. And, instead of just shutting down and getting all depressed about it, I went to work, man. I loaded up on the Amazon books. I had books being delivered like every other day. I was up at 5, went to bed at midnight, and I just started learning from my mentor, reading books, listening to podcasts, exercising. And then when I had a little bit of like confidence by like week 4 or 5, I started calling bankers. I started calling brokers in all different neighborhoods. And they're like, "I'm sorry, who is this? Like, there's COVID out there. We're trying to process PPP loans, and you're asking about multifamily loans? I'm sorry, do you have a balance sheet? Do you have a schedule of real estate owned?" And I'm like, "Yeah, I'll get that to you, no problem." I'll schedule. I'm like Googling schedule of real estate owned, and but that's how I really got started. And yeah, I'll throw it back to you.
Yeah, that's incredible. I mean, you took that what looked like a negative in your life and like a dramatic situation and turned it into a positive. And I think that's what separates a lot of people who find success in life from those who don't, is they're taking action, and they're following through with the steps that they need to take. And I think what you're highlighting is very important for, you to gain that experience. You need to take the action, and you can't just read the books. Like, so you're picking up the phone, you're calling the bankers, and you're making things happen. So I think that's great. Um, Looking back to that first deal, I'm curious with everything you've learned since then. You had mentioned that you bought it in your personal or through an LLC and not through your personal name. Would you have done that same thing again, or do you think you would have switched it up and bought it individually, looking back after having learned everything that you learned?
Yeah, I mean, and look, I have my securities licenses now, so this is by no means like me telling you what to do, right? You always got to do your own due diligence. Let me just get that out of the way real quick. But hey, I mean, if I had to do it again, me personally, I would buy with my own name, right? Because you can get up to 10 mortgages in your own name, get 10 in your wife's name, and then if you run out of mortgages and other financing opportunities, then if you have to go the LLC route, you can. There's also something called a quit claim deed. I don't know if you guys have talked about on the show before, but a quit claim is funny because if you talk to 10 different attorneys, you'll get 10 different answers about whether or not quit claim deeds are fraudulent. If they're the way to go, everybody does it. I do it. It's funny. So there is always a quit claim deed that you can possibly do, and which is just assigning the property to the LLC once you already own it with your personal name and your financing. What I did learn through that process is if you just talk to your local banker, like if you get your a loan through a community bank and you can establish a relationship, a lot of times the banks will even tell you like, yes, we have no problem with a quit claim deed. We do that all the time. Or, oh my God, that's fraud. You can't do that. And like you'll learn very quickly if your bank is on board with a quit claim deed or maybe they're not. I wouldn't go to them on day one and say, hey, I'm going to do this. I'm going to quit claim it. What do you think? So yes, no, I would do that because you get the better financing terms. And listen, if you can get something at a good basis, the basis is forever. And they always say you can date the rate, but if you can qualify, especially as a first timer for preferred financing upfront, I'd always go that route personally.
Right.
I
And
totally agree.
it's always a business decision too. You got to use your business judgment whether or not you want to quit claiming or not. I think the important thing, which you've done, is speaking to a couple people and getting opinions, and at least informing yourself of what could happen and what it means and what you're doing. And that's the important part. And the same can be said about anything else you can do, business wise. Is it's a business decision. So.
You know what I did do when I did do the refinance, a year or 14 months into that three family, I quit claimed it into we refinanced into our personal name, and then we quit claimed it into the LLC that we had set up, and then we each bought an umbrella policy for our own insurance. So we had a $2 million. I had a $2 million umbrella policy, and so did he. And I said to myself, all right, now what's the worst that can happen, right? I mean, I got insurance on the house. I got, my ducks in a row here. It's in the LLC. My bank was cool with it. And now I have a $2 million umbrella policy on my life, basically. So I think I should be good to go here,
Exactly. And I think it's the age-old question, and it's one of the things that I think hangs up a lot of first-time investors and people in the beginning. And you hear it from experienced investors that have something to lose, always say, put your property in an LLC for protection. But when you don't have any assets, when you don't have anything to lose, it doesn't really make sense to put it in the LLC because, like you said, it's more expensive. There's more points. There's more money up front. You get worse terms, worse amortization. So it's harder to make the property cash flow. You have to come up with more money out of pocket. And as someone who doesn't have any assets and is looking to build up that small cash flow, you're hindering yourself by doing that. But the cheapest way to really protect yourself, like you just said, is through that umbrella policy. I mean, I have a $5 million policy that's $400 a year. Like, I'm covered. I still have some properties in my personal name because I do have great terms with it, and like you said, you can transfer them in. When I decide to maybe do like a portfolio loan or something like that, I'll transfer them in there when the time comes. But, like you said, not until you get to those commercial 5+ units is when you really need to start using that LLC, unless you hit that, like you said, 10, possibly 20 loans between you and your spouse. So I think that makes a lot of sense. So we're through that first property. You got that 3-unit, you got that triplex, you doubled your money. Did you go out and buy some more small multis, or did you jump right into those big properties? Where did this journey head?
Yeah, so now, as you can probably tell, I was addicted, right? I was like, wow, this is awesome. And I now I can't stop, right? And right around the time of my closing, in 2019, I started Cityside Capital, and my brother Greg, who's 4 years older than me, is in Virginia, and he's into real estate. He used to be a developer out in Boise, Idaho, with his wife's family's business. My sister-in-law is also a realtor in Virginia, so they're very real estate focused, and they saw what I was doing. They're like, dude, can I join you? I want to be on this, whatever you're doing, this journey. I want to be on it too. And I was like, all right, bro, yeah, let's do it. Come on. So we ended up getting mentored, and because we needed to really understand multifamily commercial real estate in general is like a different animal, right? It is cap rates and spreadsheets and net operating income and P&L statements, profit and loss, and T12 and rent rolls, and a lot of macro data, data, whatever, however you want to say it, right? And if you don't know what you're doing, you can get in trouble really quickly. Whereas, I feel like in a single family rental, if you don't know what you're doing, you could probably fake it until you make it, right? You can really kind of gut through it. And I didn't want to be the guy to mess things up, right? I wasn't in this to lose money. I wasn't in this to get rich quick overnight. And I just really wanted to learn from somebody that was already in the position that I wanted to be in. So, I ended up being invited to work on a deal that my mentor was working on, my coach. And he gave us the opportunity of a lifetime to kind of follow him through a syndication. So, a syndication is just nothing more than a group of investors or limited partners, pooling their cash together and buying a bigger complex, right? Like a multifamily. So anyway, my coach Chris was buying a 43 unit in York, Pennsylvania, of all places, because he was moving to that area with his family, and he can't sit still, right? So he's looking for a single family place to put his family in, and he's also with one eye looking at the commercial real estate in the area. So he gets a 43 unit under contract, and he's like, listen, I want you to see how it works from the inside, due diligence, the financing, property management, everything. So I did. I looked at it from the inside, and at the end of the project, he asked me, do you want to give some capital raising a chance? You want to try it out? And I was like, man, I don't know. Like, I had a Yahoo email account, and I'm like, I guess I can email some of my friends and family and college roommates who I think have money. I'm not sure, So I said, don't count on us, but we'll give it a shot. So I basically went down my Yahoo email list, and I just started clicking off names that, that's a rich uncle, that's my rich neighbor, or whatever, my college roommate, he has money, so, and I got I don't know, 20, 30 people onto the webinar. And of that, everybody pretty much said, Tim, I love where this is going. You look like you're really into something great. But let me know when the next deal comes. I want to see how you do on the first deal, So I said, oh, great, man, thanks. I ended up raising $150,000, so Greg and I, which we thought was just an incredible amount of money for not having any real experience kind of doing that, right? And then we invested our own money into the deal. And to this day, that deal is printing cash. And that closed August of 2020. So we were 7 months, whatever. I hate public math. 5 months into COVID, right?
Yep.
March 2020 started. So we closed 5 months later. I mean, think about it. The stock market had taken a dump on us. There's fear in the streets. We're locked in our houses. And I'm like, hey, we're buying a 43 unit in York, Pennsylvania. Guys are like, where the heck is York, Pennsylvania? But that's what we
about
did.
30 minutes from me is where it is.
Oh, so you know it. Yeah, you know it.
Yeah.
So to this day, it's still printing cash, and it's 100% occupied. We push rents, I don't know how many times. The chief of police of one of the surrounding towns lives there. I mean, it's an incredible property. And my dad even sat that one out, and he's like, oh, I guess I should have gotten into that one, huh? And so that's what we did. So now we have this proof of concept, right? We're seeing the syndication model from the inside out. And we realized very quickly, though, that I lived in my private residence here with my wife and kids, and her family lives nearby. And I'm not ready to give up the firehouse, so I'm not moving to a sexy location like Phoenix, Austin, San Antonio, Dallas, West Coast of Florida, Tennessee, you name it. I'm not moving, right? My wife's not going to let me. And also, I want to finish out my career at the firehouse. My brother, same thing. He's not moving out of where he is. So we're like, we're not going to exactly be boots on the ground. We're not seasoned enough to go out and really be the asset manager. We're not really seasoned enough to understand the spreadsheets and the underwriting. But raising capital seemed pretty cool. That seemed really, really cool, right? So we did our research and we decided that we wanted to get our securities licenses because we didn't want to run afoul of raising capital the wrong way. And let me tell you, there's a lot of people out there that raise capital the wrong way. So that's what we did. I'll pause there.
That's incredible. I mean, you're the first guy who's actually raising money who I've heard of having a securities license. So I'm very curious. Let's just hit the ground running with that. What are people messing up when they're raising money? Like, what are they doing wrong? What are some common pitfalls, and what should people kind of be worried about when they're going to get into the business that you've gotten into yourself?
So, there's a lot of for lack of a better term, gurus out there that'll give a class, say, get rich in real estate using other people's money, and then the premise is, tell them what you're doing, raise the capital, and then go execute and do it, right? And that's great if you have a material participation in whatever project you're doing. But what people run afoul of the law is when you want to just get paid for raising capital for multiple people's deals, right? So, if I don't know, say you're, I don't know, a chemical engineer and you're in big pharma and everybody around you, everybody makes $1 million or more dollars a year, right? And you're like, you know what, I hate my job. I don't want to be here anymore, but I know everybody here has money and I'm going to do real estate and I'm going to raise money for 5 different people that are doing multifamily deals all over the country. And I want to get paid by the amount of money that I raise, or I want to get paid per deal, but I don't want to do anything else. Well, I think I don't know. I've heard that people do it that way. I'll put it that way. And that's not the way to do it, because essentially, if someone were to do it like that and not have a material participation in the asset management, the acquisition, the debt financing, being a key principal, underwriting, something to add value to that LLC or that company that's buying that property, you are essentially selling a security without a license. And that turns out it's a felony, and you can go to jail for that. So when I heard that, I'm like, well, that's not going to be me, because I want to sleep well at night. I don't want the FBI, pouncing down my door at 2 a.m. and doing a flashbang while my little girls are sleeping. So I'm going to go ahead and figure out this broker-dealer model of getting your licenses to raise capital. And then I can raise capital for the groups that are on the platform and get paid for it. So that's what I did.
There you go. Yeah, I mean, if you're raising money for your own deal, or like you said, that initial syndication where you were getting pulled behind the curtain for this one particular deal and you were going to see everything else, you go out there, raise 150 or $500,000 or whatever for this one particular deal, that's okay. But as soon, like you said, as soon as you start going and specifically raising money for all of these other people for their deals, and you're getting a 0.5% or whatever the commissions or whatever is, that's where it gets really, really sticky. And like you said, for lack of a better words, illegal to do. But people do it all the time. And you are right. They're kind of, sweep under the rug type of thing out there to fund some of these big syndication deals out there. So now you guys are. Go ahead.
Stop real quick, because when I first got started in 2020 doing this, there was an SEC investigation about this, right? Because they were saying, hey, what do you do? What's your role? I see you're on the operating agreement of 123 XYZ LLC. What do you do? Do you have emails to prove that you're on this? Do you have any notes? Are you boots on the ground? Have you ever been to the city that you own this property in, right? And so, I mean, to this day, that deal in New York, I'm still in the asset management monthly calls, right? I got notes, be like I got reams of volumes of notes, right? Because I wanted to have that material participation for a couple of reasons. Number one, I wanted to, CYA, right? Number two, I needed to learn the business. I wanted to be on the calls. Hey, what do you talk about on an asset management call? What do you do when someone doesn't pay rent? What do you do when there's a leak? What do you do when there's a pest control issue or something like that, right? So I wanted to really learn as much as I could and add value where I could, to understand the business. But also, just like you said, if you're raising money for your own deals, say you want to do a fix and flip, and you're doing the fix and flip, well, great, go out and raise money, right? If you're doing a 10 unit in, wherever you live, and you're going to be the one asset managing the deal, good, raise the capital and do the deal. But I can take it anywhere you want.
I like that.
Yeah,
Well,
no, I mean, go ahead, James.
I was going to say it also offers some credibility for you too now. So now you've got those licensing certificates behind you, and it gives you something to sell. And I'm curious, those people that you went to on that first one, who kind of said, "Oh, wait to see how it goes next time." Did they end up getting involved in future deals, and like how did the money raising objective go for your future rounds?
So, what's the best way to tell? So I suffered from imposter syndrome. I still suffer from imposter syndrome. Who am I to, do this, right? Who am I to have this business? Who am I? I'm just Tim the firefighter, Tim the ER nurse, right? Now I'm closing in on almost $2 billion of multifamily and self-storage. Like, I mean, that sounds crazy to even say. So what did I do? I started telling people what I was doing, right? I mean, I was being coached. I started to leverage social media. Hey, this is what I'm doing. This is my journey. I went from Tim the fireman, Tim the ER nurse, to Tim the fireman, Tim the retired ER nurse, right? Because as soon as COVID happened, I was like, I'm out. I need to go all in on real estate. And just documenting that, telling people what I'm doing, putting out blog posts, doing Facebook Lives, putting out good content on a newsletter, building my email list, going on other people's podcasts, saying, "Hey, listen, I've done 2 deals, I've done 3 deals, I've done this. Like, here's how I did it." All of a sudden, you start putting yourself out there, telling people what you do. Because if you know what you do and no one else knows, then you're not going to have a business. And I learned that early on just by listening to the podcast. I think it was Brandon Turner from Bigger Pockets saying, you have to tell people what you do. And my coach at the time said, stop telling people you're a firefighter. Tell them that you're a real estate investor. But I'm proud of being a firefighter. I have great stories. I want to tell people what I do. So I just started telling people what I was doing, and by doing that, I would start to get emails from podcasts. Hey, I heard you on a podcast. Can we hop on a call? Hey, no problem. I figured out that I needed the Calendly link, right, to set up calls on my Gmail calendar that I never even knew existed, right? And now, so that's how that started. And then you start putting out, lead magnets on your website and drawing people's attention to your website. And, little by little, we started building an email list, qualifying the people as they came in, right? We have a call script that we need to kind of hit, for each new investor. And we have to make sure that these investments are suitable for them to invest in. And then once we qualify deals and put it out to our list, we raised $500,000. Then the next one was 560, and then it was like 800, and then it was $1 million. And I'm like, holy Christmas, like this actually works, but then, it's treating investors well, right? Listen, they all have my cell phone number. They all have my email address. If you have a question, I'm always telling them, please, somebody call me. Like, I want to talk real estate with somebody, right? Even if the deal's going well, you want to talk about, anything. So, when you start treating the investors the way that you would want to be treated, right? I mean, a monthly newsletter is great, but isn't a weekly or biweekly email or phone call even better, right? So that's what we started doing. And then, people tell their friends. My family started seeing what I was doing. My college roommates, my coworkers at the firehouse, even though they call me Lieutenant Madoff and they'll ask me how my Ponzi scheme's going. They're all kind of looking, and that's how it spread.
That's amazing. I love it. So it sounds like your business of real estate now is not necessarily owning the assets, it's connecting the capital with the asset and taking a fee in between there. So, this podcast is all about financial independence. It's about reaching that goal, while hitting those financial markers. So you said you retired from, being the ER nurse, and, you're still the firefighter and you're doing this. Can you kind of peel back the curtain a little bit and, let some people know kind of either, what that number is that you're working towards, or when you were able to quit and being an ER nurse because your income from this started to increase?
Yeah, so I left. So I bought that three family November of 19. 4 months later, COVID hit, and I said, I'm out. I got the real estate. I'm making a couple hundred, whatever I was making, between 400 and 700. We started around 4, we increased to about 700 a month each in cash flow. So I'm like, oh, this is great. Like, I don't have to work for that, really. I mean, I did kind of, I guess, but I wasn't putting 12 and a half hours in on the critical care side of the ER, I'll tell you that. And so that was one thing, right? And then what I did was I actually took a HELOC on my home, right? So I took a $250,000 HELOC. I also took $100,000 from my retirement account using the CARES Act. When you could pull money out of your retirement account penalty free, and you could split up the taxes over 3 years. I'm like, oh, sign me up, right? So now I had 350 on top of the liquidity I already had, and I started to invest in all the deals that I was doing. So I started, little by little, putting money into these deals and then reinvesting whatever commissions we made from these deals, just putting them back into more deals, right? And I was able to stack, a couple of $1,000s a month in passive income. And I said, this is great, so really that's how it started. The way the broker dealer works is, look, we have 9 operators, and when I say operators, syndicators, that's really synonymous, right? So we work with 9 groups across the United States that are best in class, right? So we do a whole due diligence underwriting on each group before we invite them onto our platform and raise capital for them. So they got to be in a good market. They have to have track record. We have third-party due diligence firm called CrowdCheck that actually goes and checks the LLCs. Are they in good standing? We have an in-house underwriting team. So, like, what is their initial underwriting compared to their exits? What's their initial underwriting compared to where they are today in their current projects? Are they paying investors like they said they're going to pay investors? How do they communicate? What's the cadence? What do they provide on those investor communications? So all of these things, are they third party managed, right? Or are they vertically integrated and they own their own property management company? All these things come into play, whether or not we want to play in the same sandbox with these groups, because, when everybody's making money, everybody's happy, right? If project starts going sideways, everybody starts getting sued, and it's not a pretty sight, right? So we wanted to make sure that the full-time firefighter that has 3 kids and a second job, who doesn't have the time or the knowledge or the skill or the know-how to do underwriting, to understand commercial real estate, to go down to the county clerk's office and make sure the tax bill is paid. We wanted to provide a service for people that says, hey, look, we make sure that this investment is suitable for you as the limited partner passive investor, but we also want to make sure that we're doing our due diligence on the operators themselves. We spend a lot of time and a lot of money doing that. Even doing site visits. My broker dealer flies all around the country and sees all the properties that we're going to invest in, because we want to make sure that our diligence file is sufficient enough that we can attract not only retail capital from everyday investors, but 1031 exchange capital, DST capital, and institutional capital from pension funds, and the like.
That's so interesting. And what I really love is that this is a totally new way for people who are out there that want to get into the real estate game. And it's another way to do it. You found another way to be in the business of real estate, to be investing in real estate, but not necessarily managing the asset. You're more managing the people and the capital of the asset, which is really, really fantastic that you got hooked on on doing it. So you have experience with managing the asset and the tenants and all of that. And you found a niche that that you saw was out there that could be beneficial. And now that's how you built a business and have become, financially independent. So what does that look like? What's the goal for Cityside Capital? Like, do you have a number that you guys are trying to reach of investors you're trying to help become financially free? Is it a monthly goal? Like, fill us in on what the big picture of the company is.
So the big picture for us is to be able to like our little motto between my brother Greg and I is we want to be able to do what we want whenever we want to do it with whomever we want to do it with, right? So we want to have time freedom. So like the dollars and the cents really has to do with, what does it take to be able to work from home? Because both of us love working, we love real estate. We don't see ourselves, even if I hit the lottery tomorrow, I would still wake up and listen to podcasts and buy real estate, right? Because it's just fun. I struggle because I love being a New York City firefighter. And when I got on, I could retire at 20 years and get a full pension and benefits for, my family and stuff. And I've thought about leaving early, and because this is a much more lucrative route to get there quicker. But I can't take myself away from the firehouse just yet. I love it too much, and I'm 2 years away. This month will be 18 years. So I mean, look, I'll be in a great position. I'll have, in 2 years, I'll have my pension, which will be phenomenal. I'll have my retirement accounts, and then I'll have Cityside Capital, right? And then we've already invested a lot of our earnings back into these deals. And what Greg and I always talk about is the conveyor belt. Are you guys familiar with the conveyor belt?
Now, fill us in.
All right. So if you picture, so a lot of our deals are $50,000 minimums, right? And we do both 506B offerings and 506C offerings for accredited investors only. So our goal was in the beginning was, if we can each put $50,000 a year into a property, right, into a syndication. And then the next year that kind of moves down the conveyor belt, and we put another 50 on for this year. Now those two move down the conveyor belt, you put 3 on, because generally speaking, it's a 5-year hold period, right? So at the end of 5 years, the first one would drop off the conveyor belt, right? And now we can take the initial capital from that deal plus the upside, whatever it is. And now that's my year 6, on the conveyor belt. So the idea was take 250 and do $50,000 a year. Well, listen, I've been blessed and grateful. I could do a little bit more than that, right? We've done 21 deals so far. And Greg and I invested in almost all of them. So we've been able to build out the conveyor belt. So as those deals end up maturing and falling off and going what's called full cycle, now we can take that initial capital, the upside as well, and put it back on, right? So we're looking to stack those opportunities on top of each other to build massive passive income, right? And it starts out small, right? 50,000 a year is a lot of money to a lot of people, and I understand that. But if you're able to, right, you're an entrepreneur, you're a highly paid W-2 worker, you're a real estate investor, whatever it might be, this is a great way to kind of, my goal was even to pay for college doing that, right? Because I want, if you talk about goals, I don't even know. Like if you talked to me 4 years ago, 10 grand a month was going to do it for me. Man, if I can make 10 grand a month in real estate, but then I told myself, well, why not 20 grand, right? I don't know. Why not 30? Why not $50,000 a month? I mean, because the level of conversations I've been able to have by doing this business, people are doing that. People have 50, 70, 100,000, $200,000 per month coming in, either passively or actively involved in real estate, or combination of both. And when you see what's possible from other people that are not that much older than me, that maybe didn't even start, that much before my time, you can really say to yourself, like, I'm thinking way too small. I'm thinking entirely too small. This is what's possible. And it's not because I want the hot rod in the driveway, but I do want to be able to tell my kids when they go to college, I want you to pick out any college, if that's what you want to do, and I'm going to pay for it. I also want to take them on vacations. I also want them to have what they need, but not spoil them. I also want to be able to, the way I grew up, if the water heater went out, we took cold showers for 2 weeks until payday. And I don't want them to have that. So I don't know if that answered your question, but
It did. It did. That was really good. So for someone out there that is listening about a full cycle syndication, typically 5 years, you get your capital back. What kind of returns out of those, nine preferred syndicators that you guys use? What's the average, preferred return out there that say someone who is an accredited investor invests that initial 50,000? What does that full cycle return typically look like?
so there's two things you asked about: preferred returns and then full cycle returns. So preferred returns, you're going to see typical these days is going to be a 5-year hold, a 7 or an 8% preferred return, and I can go over that in a second if you'd like me to. And then as far as a full cycle deal, you're looking anywhere from say 15 to 20% average annual return. So ideally, we'd like to double your money, or I want to double my own money over that 5-year period, right? So again, so my compliance officer won't jump up and down on this. This is not a solicitation or an offer to buy or sell securities or offering any advice, but 15 to 20% is not unrealistic on a lot of these deals per year, average
Yeah,
annual.
so average over five, that's where you would double your money,
As far as
makes a lot of sense.
the preferred return, just you want me to hit on that real quick?
Please, yes.
So if you see a deal deck come across your email inbox that says, I don't know, 8% preferred return, 70-30 split, 5-year hold, right? This is the way that it works. And it's a value add multifamily in, I don't know, Texas. So say on a value add simply means, listen, we're going to do some renovations. We're going to make a dog park. We're going to redo the pool. We're going to redo the barbecue area. We're going to redo the gym. There's some value add plays. And as people move out, we're going to go and do a renovation scope, and make that a nicer apartment to capture a premium in the market, right? But that takes time. So year one cash flow, let's do a hypothetical deal, right? So we have 8% preferred return, 70-30 split, 5-year hold. Say the first year cash flow is only 4%. Well, that's not 8%, right? So, and you told me the preferred return was 8. Well, it accrues during the life of the deal, right? So year one, you only got paid 4. So now we owe you 4. Say in year 2, we also pay you 4. That's not 8. So now we owe you 4 plus 4. Now, say the market's great and we sell at the end of year 2. This is the way the capital gets unwound, all right? We sell the property. We give you your initial capital back. So if you put 50 in, we're going to give you 50 back. Then we're going to catch you up on your preferred return, right? So if you remember, we only paid you 4% year 1 and 4% year 2, and we owe you 8%. So we give you your 50 back. Now we're going to make you whole on that preferred return and give you, a check for 8% to catch you up on your years 1 and 2 preferred return. And then we split anything after that 70-30. 70% to the limited partner or the passive investor, and 30% goes back to the general partnership.
Makes a ton of sense. I think that was a great explanation out there for everyone listening on how that preferred return works. So fantastic. I love it. I love it. I love it. I really want to get into, you gave us the goals for you providing for your family and everything else. Let's really get into the goals, real quick for Cityside Capital. And, let's say the next 3 years, like what are the goals of the business? What are you trying to accomplish? Is there, a number to raise? Is it a number of people to help bring in? Like, what does that look like?
Yeah, so we want to Greg and I mean, we have our own internal goals, but really what it centers around is raising 10 million a year, right? Because we get a percentage of the capital raised, and it doesn't come out of the investor's pocket, by the way. It's the cost of capital for the operator for us to bring them capital. So they're the ones that pay us. So just so everyone's clear, if you invest $100,000 with us, we're not going to credit your account, say 97,000. Right? No, you get 100,000 in your capital account, and the burden is for the operator to pay us for bringing the equity to the deal. But we want to raise 10 million a year at the absolute minimum. because we just feel like that conveyor belt of raising 10 million a year, and then as deals fall off, getting paid the equity on the back end, it's really where, like, I guess, a sweet spot. And we feel that 10 million
Thank
is a
you for
very
listening to
doable
the
number for
Real
us.
FI podcast,
But we
where
do
you
feel like
learn from
we're
the
thinking
investors
too
that have
small
lived
all
the
the
hard
time,
lessons for
because
you.
all of
To
a sudden we
connect
get a
with us
phone
during
call,
your
"Hey, we
pursuit
have
of
$3
financial
million
independence,
1031."
be
You know,
sure
it's
to
that,
join
"Hey, we
our
have $10 million
community by
1031."
following us on
Like, oh my God.
Instagram or
You know,
emailing us at
that's what we want to do for the entire year, and now we're gonna do it
info@therealfi.com.
in,
If this
you
content
know,
made you
2 months,
financially,
you know? I mean,
mentally, physically,
so
or
I don't know where that
spiritually
sweet spot
richer,
is, to be honest
please
with
make
you.
sure to
But,
leave us a positive review on your
God
preferred
willing, this
content
business is
platform.
going the way it
Cheers to
is,
kicking the
and if we
9
can
to
do 10 million
5.
a year, I mean, we're going to be in great shape. As far as, I think you hear people say, I want to hear, I want to have 1 million people be financially free by the time I'm, whatever. I don't know that, but I want everyone who hears my story to know that there's a different way. You can do cash, you can do retirement accounts, especially for all my first responders out there. I really feel, and my military and first responders, my medical workers, I really feel like I'm in the trenches with you, and that sometimes we don't understand what's available to us, right? So, once you're retired, I want you to keep that money intact, right? And I not that I hate on Wall Street, but I think there's another way to do it. So you can use retirement money, you can use cash, you can use trust, you can use entities, and just really kind of making that value known to people is what I'm really after.
And I know you guys are going to hit that 10 million mark before you even know it. And
Oh,
once you hit it, you're going to be expanding your goals, and that's all it is. It's a game of refining and keeping going, and it's just one of those processes. And I'm curious, what are some of those obstacles you think you're going to have to overcome to reach that $10 million raise per year mark? So what are some of the things that you're going to try to overcome to reach that?
I think there's a ton of limiting beliefs out there, because if you get stuck in the vortex of mainstream media, financial news, CNBC, you're going to take your money and bury it in the backyard, right? I mean, because there's fear, there's uncertainty. You're like, oh my God, like I need to buy treasuries and what the money market, I mean, like, and that's all I need to do, right? But when you get out of that and you start surrounding yourself with like-minded folks, you can make better decisions. People that have been in the fight before, people that are doing the thing that you think you want to do. So the obstacle is really getting information out to people. I mean, the data and the sources that we subscribe to cost a lot of money, right? So in my monthly newsletter, I tried to get a lot of that data out, a lot of that, this is what we're seeing on Main Street versus what we're seeing on CNBC or, Fox Business or something like that, or the Wall Street Journal. And I'm not discrediting any of those sources, but, that's what sells. And I'm looking at what the data is and what's happening, right? And where the trends are going. And believe me, like, as a New Yorker, you're guilty till proven innocent. I don't want to lose a dime of my own money, and I surely don't want to lose a dime of yours either. So putting my money where my mouth is, I want to be able to raise that 10 million. And we basically base that off of $50,000 minimum. And anything that comes in on top of that is just gravy.
That's awesome. That's awesome. Well, before we get into the last segment of the show, I gotta ask, since you're subscribed to all of this great info, what are you currently seeing for, the next 6 to 12 months in the large multifamily space, out there, across the country, or if you guys have a specific niche in the Northeast or the Midwest, like what are you seeing right now? Because today is May 1st when we're recording this. There's a lot of stuff in the media about regional banks and commercial real estate, and multifamily gets kind of lumped in there. So what are you guys boots on the ground kind of seeing for the next 6 to 12 months?
So you're 100% right. The Fed has a meeting today, tomorrow, and Wednesday, right? They're going to probably raise another 25 basis points and then maybe hold, who knows. We have First Republic going down today, being bought up by JP Morgan. And there's this stat out there, and I'm probably going to butcher it, but about 70% of the commercial real estate loans are held by the small regional, small banks and regional banks in a disproportionate number, right? So what they're saying is that the office, especially office, is commercial real estate. And, if you had a 25 or, say 50,000 square feet in a big city, paying, I don't know, $10 a foot, and everybody's working from home. Well, guess what? When the 10-year lease is up, you're going to say, look, instead of 50,000 square feet, I need 10,000 square feet, and I'm only going to pay you $350 a foot because that's all it's worth. Well, guess what? They're not operating income goes through the floor. And when their note matures and they got to refinance and roll over that debt, they're not going to be able to support the value that they once had. And it's going to wipe out the equity from the common equity in the capital stack, and maybe even the pref equity or the mezzanine debt that they had. So there's going to be a lot of trouble in the office space, I believe. Also, I think in multifamily, there's a lot of people that were saying, hey, multifamily is great. I can make a lot of money. Everyone's making money. Let's go do it. Let's go put together a syndication. Let's go put together this deal. And, bridge debt. Oh, that sounds great. That sounds better than agency debt or 10-year fixed rate debt from a bank, because bridge debt, which is just variable rate debt, has a lesser prepayment penalty. Well, a lot of our portfolio does have bridge debt, but we have a rate cap, right? It's capped, whatever the rate is capped at, say, 150 basis points above our strike price. And meaning that our interest rate can't go above a certain amount. Well, newer, less experienced people probably said to themselves, that's really expensive. And, the Fed said they're not going to raise rates, so we're not going to buy a rate cap. Why are we going to waste money on a rate cap? Well, guess what? Their rate went from 4 to 9, in the last, 13 months. And now their reserves are just hemorrhaging, and they can't support the property. So there's going to be, and they can't roll over the debt, right? So I think there's going to be some pain out there. There was a big story last week about a guy in Houston that lost like 3,200 units.
$229 million.
Yeah. And there was at least 20 million of common equity from folks like us in that deal that got wiped out, right? So that's precisely why I started my business. That's why I went and I got my Series 82, my Series 63, and I work with a broker dealer, and we have a compliance officer and in-house underwriting. And that's exactly the reason why I did what I did, because I wanted to work with best-in-class folks and not the other ones. Now listen, there's a lot of new supply coming on the market, right? If you just Google multifamily new supply, it's going to be like, oh my God, it's going to be new supply Armageddon. The new supply that comes on any market is by and large a Class A property, right? We're talking sexy pictures. We're talking about nice gyms. We're talking about concierge service, pools, indoor pool, outdoor pool. That's like, say, $4,500 a month. Now, I don't know about you, but $4,500 a month in say Miami is a lot of money, right? And what you're seeing is that, in the news, they're saying, well, new supply is coming on, prices are going to fall through the floor. Well, that's for the new supply. So instead of 4,500 in their pro forma, they're probably going to get 3,750. So to them, and again, I can't do public math, but that's probably like close to a 20% drop. Where we play in the B and C class space, right? It's sticky, it's resilient. It's somebody in a recession that's paying 4,500, whatever. That's too much money. Say someone's paying 3,000 in a nicer community, maybe they can spend 2,100 in a B class property with an older set of bones on the property and an older pool, and not the sexy gym and the sexy pool with the nice multicolored sail shades. So I think there's a resiliency. The B renter can drop to the C space, the C renter can drop to the D space. And again, in the good times, the D can gravitate to the C can go up to the B, and so forth.
Agreed.
I think that's really
Agreed.
smart for being in the middle there. And, I think the difference, which is pretty obvious between the office and the residential, nobody's remote living yet. They haven't figured out the whole metaverse thing quite that well yet. So, there's always going to be a demand for housing as opposed to the office space. So I think it's a great point. I like conceptualizing it in the way that people can move up and down in the asset class of the type of housing they're going to live in. And of course, that A-class housing is going to be the first to get hit. But yeah, next couple of months is going to be interesting, to say the least. So I'm very curious to see how it all plays out. It's going to be interesting times. Opportunity for many people as well.
Big time. And that's where we're positioned for that right now. I think the seasoned investors are also positioned for that. They're still investing with us. It's the newer investors that are more gun shy at the moment. But listen, I mean, I've become a macroeconomic nerd over the last couple of years. If you guys read about the inverted yield curve, they're calling for a pretty decent recession coming in second half of 23, beginning of 24. And with that, usually rates, when they drop precipitously. If you look at history as an indicator, now I don't want to bank on that. I don't want to underwrite to that. But on the other side of this recession, say by this time next year, I believe that rates will be 200, 300, 400 basis points lower than where they are today, which means cap rates will maybe start to compress a little bit more instead of dropping. There's a saying, survive till 25. So we'll see how that goes.
Man, well, I think this is the perfect segue. We have packed this episode a ton with all kinds of great information, such a great story. And I think it's a perfect segue into the last segment of the show that James and I like to call the Big Four. James, kick it off.
All right, Tim, big question for you. What's something that you do in your life that's like a financial independence hack, something that's like a cheat code that's really propelled your finances forward?
I learned about that. I declassified it from the 4-letter word and I made it a friend of mine. I learned about productive debt and I went ahead and I used it. And now I'm able to do what I do and I get to sleep well at night.
Gotcha.
Love that. Love that. Good debt. There's a difference between good and bad debt. That good debt, is it good? So I know you've listed off a lot of great books. But are there any resources out there that have really shaped your financial independence journey that you think our listeners out there would have a huge impact on, books, podcasts, people that someone might not know about that you think would benefit our listeners?
Well, I hope they have a pen and paper out because I'll just shout a few out. I mean, we talked about Rich Dad Poor Dad. We talked about The Cash Flow Quadrant by Robert Kiyosaki. We talked about Tax-Free Wealth by Garrett Sutton. There's also a book about real estate taxes by a woman named Amanda Hahn. She writes for the Bigger Pockets folks, which is awesome. And then she has a second book with the advanced strategies for taxes. Because the thing about taxes, real quick, is that if you make it your friend and you understand it, you take the fear out of it. And all you have to realize is it's a set of incentives to help you grow your wealth. Then it's like it's an awesome reading topic. But more mindset stuff, Think and Grow Rich. There's a book called The Wealthy Gardener. It's my favorite book in the whole world by John Safirek. Why Doctors Don't Get Rich is another great book that is really relevant to my business with syndication. And then podcasts. I mean, I started with Get Rich Education with Keith Weinhold. I started with Jake and Gino podcast on multifamily. What else? The Real Estate Radio Guys, great podcast, and they have great events. If you're looking to go to events that are not back of the room, sell you everything, the Real Estate Radio Guys have a set of fantastic events all over Texas and all over the country, actually. So how did I do? There's enough resources?
That is fantastic. Yes. So I love it. I love all of those. They're great. I wrote a couple down. So everybody out there, go buy them, go listen to them.
Yeah, I'm going to go check out The Wealthy Gardener. I've heard about that one before. Haven't read it. It's come highly recommended. So I'm going to take a look at that one. All right, Tim. Next question. Future you. It's 5 years in the future. Where's your life personally, and with business? Are you still firefighting, or have you totally left that behind? 100% real estate. Paint that picture for us.
Oh man, 5 years. I love doing this kind of stuff because I've really had to get out of my comfort zone about thinking so small and thinking in 2-week increments. In 5 years, my kids will be 17, 14, and 9, and I'll be retired. I will be financially free ×2, and just working on my health, working on my relationships, raising capital. Hopefully by then I might have made enough money maybe to start doing my own deals. I still struggle sometimes because I wish I was in the driver's seat, sometimes. So maybe doing a combination of broker dealer deals and maybe my own deals, because there's just a lot of opportunity out there. And what I found in real estate was that real estate investing specifically is that it's not a steamroll type of industry, in my experience. People are always willing to help you out, take a phone call, JV a deal with you, lean into education and mentorship. So I think I can do a lot of that because I've received a lot of that as well. So
Perfect.
Fantastic. Fantastic. All right. Last question is, where can our listeners find you? Where can they reach out if they want to tell you they enjoyed this podcast, if they're interested in possibly investing some money in your deal? Where's the best place to get in contact with you?
it's my email, tim@citysidecap.com, and also the website. We have a free download if you want to check that out. Kind of goes over some of the stuff that we talked about today. That's citysidecap.com. You put your name and email address in. And I like to hop on calls, right? So there's a button to set up a call on the website. I take every single call that comes through, whether you're just kicking the tires or you want to, find out more about my journey or find out how to invest with us. It's something that I love to do. So those are the best ways. I'm on social too, but I don't always get to my DMs in time. So you might be waiting a little while.
Hit that email.
Gotcha. Well, all that stuff's going to be in the show notes. Tim, we appreciate you. This has been an awesome podcast. You guys know the drill. We put out this podcast for free, but it isn't quite free. All we ask you to do is hit that like button, leave us a review, Apple, Google, Spotify, any of those, hit the thumbs up, drop us a little comment, send us a DM. That's all James and I are working for here, is for you guys. So show us some love, do that for us, and we'll catch you next time. See ya.
You guys.